of weeks ago, I spoke about the Federal Reserve and I said that what had happened is that my Fed funds rate model had declined by about 50 basis points. And so I thought that what would happen in the final quarter or final part of the year would be that there would be 2 rate cuts and by the Federal Reserve of each of 25 basis points. And my guess at the time would be that that would happen in the 2 last meetings of the year, and that they occur in November, the beginning of November, just after the election, and December. So I was interested to learn during the week that one of the 2 former Fed members that I really rate, and his name is Roger Ferguson. The other one is Kevin Walsh, and I'll talk about Kevin Walsh in a moment. Roger Ferguson was vice chair of the Federal Reserve from 1999 to 2006, when there was somebody who now is entirely forgotten called Alan Greenspan was chairman of the Federal Reserve. Greenspan served for 3 terms, 21 years in the job. But Roger Ferguson was his deputy from 1999 to 2006. And Roger Ferguson, in an interview, suggested there would be 2 rate cuts. But the first one would be earlier than I thought, and that would be in September, and the second one would be in December. But I'll stick to my own view that there were 2 rate cuts in November and December. The other really guy that I really rate as on the former member of the Federal Reserve is Kevin Walsh. Kevin Walsh was a Federal Reserve Board governor from 2006 to 2011. And the reason I rate him for a whole bunch of reasons, and particularly his understanding of defining liquidity and the function of liquidity during the worst parts of the financial crisis. He was the guy, as a former Wall Streeter, he was the guy who best understood what was happening. And when it's my understanding that when the shortlist was put to Trump about who he wanted to appoint as head of the Federal Reserve, there were 2 people on the shortlist. One of them was Jay Powell, and the other one was Kevin Walsh, and both, of course, were registered Republicans. Kevin Walsh wrote an article in the Wall Street Journal, which pointed out pretty forcefully that what was really important when in the current circumstance was quantitative tightening, because unless the Fed kept selling bonds into the market and tightening through providing more volume into the bond market, then rates would be going up and not going down. So what's important about, one of the important things about this morning's statement is, apart from the expectation about interest rates, is the statement of the continuing tightening through selling bonds and continuing quantitative tightening. So what the statement said this morning, that the committee does not expect it would be appropriate to reduce the target range. It wasn't reinforcing the idea of a September rate cut at all. It would not be appropriate to reduce the target range until it has gained a greater confidence that inflation is moving substantially towards 2%. In addition, the committee will continue reducing its holding of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to returning inflation to 2%. But of course, given the betting market favours a September rate cut, what we found was after the formal statement, Jay Powell, when he spoke to the press conference, was consistently asked about this idea of the September rate cut. But what he went out of his way to point out was that he was the one person who really didn't know, because the data didn't yet support it. And he said, and I quote, "We have made no decisions about future meetings." And he said that it was all about the totality of the outlook, the growth in the economy, the growth in the labour force, the growth in demand. And he said, we're not quite at that point yet. When asked when it would be appropriate, he said when inflation is moving down quickly. And when a second person asked him when it would be not appropriate, where if inflation would prove to be sticky. Now, we've had over the last few periods of falling inflation and sticky inflation, so really it's a pretty random call in fact as to whether or when precisely the rates will fall. He was also asked in the press conference, given that Jay Powell is a registered Republican, he asked, would a rate cut in September be deferred for political reasons? But in this circumstance, he was very strong on the point that no, the Fed doesn't do anything at all for political reasons. So it'll be purely on what inflation is doing, whether it is sticky, there'll be no rate cut in September. And if it's falling, there will be a rate cut in December. So where we get to at the end of this is, my view continues to be that there will be 2 rate cuts in the last 4 months of the year. And my best guess is November and December. But the alternative to that is Roger Ferguson's view that there will be 2 rate cuts, one in September and the other one in December. Otherwise, either way, you'll get 2 rate cuts. And rates should fall by 50 basis points in the last 4 months of 2024.